In this video, I'm going to walk you through an outline of the event analysis. There are three important time windows in the event analysis. The most important is called the event window. Before you carve out the event window, you have to figure out what is the actual event date. Event date is usually in reference to the date when the announcement is made. So it's also known as announcement date or AD. Event date is usually marked as T0 on the event analysis timeline. Once you figure out what is the event date, then you can start to carve out the event window. The start date of the event window is usually a few trading days prior to the event day, and the event window will end a few trading days after the event day. Now, once you carve out the event window, you can start to establish the estimation window. Estimation window is where you're going to establish the normal trading pattern of the company that you're analyzing. So the length of the estimation window is usually 252 trading days. So the estimation window usually ends 1 trading days prior to the start of the event window, and it will expand 252 trading days 252 trading days prior to the end date of the estimation window marks what is the start date. Why 252 trading days? Because there are roughly 252 trading days in 1 year. So you are trying to use 1 years of trading data in order to establish the normal trading pattern for the company that you're analyzing. The third time window for event analysis is called a post-event window. And this time window is usually used to explore what is the long-term impact of this particular announcement. And this time window usually starts 1 day after the end of the event window and could last a few months or even a few years after the starting point of the post-event window, depending on how long the long-term impact you want to evaluate. The estimation window, the auto analysis in the estimation window is also known as the ex ante analysis. And all the analysis you're doing during the post-event window is called an ex post analysis. Okay, those are just two jargons that people like to use when they're doing event analysis. Okay, let's look at what we're doing specifically under each event window, under each time window. During the estimation window, the length is usually 252 trading days. So that means in order to download the data from CRISP, you have to download at least 252 trading days of stock information from CRISP prior to the start of the event window. And within this 252 trading days, you are going to use a market model to capture what is the normal parameters. You are trying to use the market model to establish what is the normal trading pattern for the company stock by estimating the parameters in the market model. So the main variable in the market model is on the left-hand side, the daily return of company I on day T. So on the left-hand side, it's what is the return of the company stock. And on the right-hand side, it's what is the market return or the benchmark index return on day T. So you regress the individual stock return on day T on the benchmark index return on day T in order to estimate what is the intercept, alpha, what is the slope, beta, and you're trying to also estimate what is the standard error from this one variable regression called standard error regressing y on x. Once you estimated the three main parameters, then you can use these three parameters to calculate the predicted return for each company on each trading day using a corresponding market return on the same day. And that's what we're gonna do during the actual event window. In the actual event window, say we have already carved out the length of the event window. Say it could be 2 days prior to the announcement and 2 days after the announcement, or 1 day prior to the announcement and 3 days after, or even as long as 10 days prior to the announcement and 10 days after. The actual length of your event window depends on how early you assume that the information start to leak out prior to the actual official announcement. For example, if it's a sudden airstrike for the company, for example, like Aramco, like a Saudi Arabia oil company got attacked, and the oil price dropped. And then since the attack is cannot be predicted and no one can trade on this piece of information prior to the strike, so the event analysis for that type of strike should be very short. It should be like 1 day prior to the announcement and 1 day after. But for something like quarterly earning release, it's the earning release for each of the public listed companies. They are pre-scheduled, so everybody knows on which day those companies are going to release their quarterly earnings. So since everybody knows the earning release date going into it, so everybody start to probe into the information and start to trade on this piece of information like maybe as long as 10 days prior to the actual announcement of the earning. So for earning release, the actual event window needs to be much longer. So we usually start 10 days prior to the announcement and 10 days after, because there's a huge amount of leakage and prior to the announcement of the earnings. So this event window is really your based on your personal judgment call on how early the information from this event is gonna be leaked out. Okay, once you carve out the actual event window, then you're going to start computing abnormal return corresponding to each of the trading days within this event window. So abnormal return for each day in the event window is calculated using the actual return of this company on each of the trading days minus the predicted return of this company based on the market model on the same trading day. So you're going to download stock return from CRISP to look up what is the actual return for this company on day T, and minus the predicted return by plugging alpha and beta and plug in what is the actual return of the market return on the same day. And together, this term gives you what is the predicted return for this company on day T. And the difference between the actual return and the predicted return gives you abnormal return. And abnormal return could either be positive or negative, depends on how the actual return is compared to the predicted return. Okay, once you computed the abnormal return, the next step is to conduct a hypothesis test to test whether the abnormal return is 0. In the null hypothesis, you assume the abnormal return is 0. When abnormal return is 0, that means there's 0 impact on the actual return of the company. And the alternative is abnormal return is not equal to 0. So if we were to reject the null and accept the alternative, that means the impact for the announcement on the company's stock price is material. Very important that we establish the return is material by rejecting the null. And the way to conduct a hypothesis test is to compute what is the t-statistics by using abnormal return minus the hypothesized value. In this case, the hypothesized value is 0. The difference between abnormal return minus 0 and divided by the standard error of the regression, which is estimated in the estimation window, gives you a t-statistics. And using the critical value for t for a two-tail test, the critical value is 1.96. So if the calculated t-statistics is greater than 1.96 or smaller than negative 1.96, then we say we have enough evidence to reject a null. And when we reject a null, we go with the alternative that gives us the abnormal return is not equal to 0. And when abnormal return is not equal to 0, and then therefore we can conclude the announcement has a material impact on the return of the company. And that's our final conclusion. And this is how event analysis work.